Let's talk about broadcasting. For that, we'll talk about Nexstar. We got to be careful here because we both work for Nexstar on Fox 5 and KSI.
Do we volunteer? I mean, we're not paid guys.
We're not paid guys, but we're commentators. So, but they're in the broadcasting industry. Not a good start here. The short on the float is 8.2%, about 100% ownership, institutional. Wow. We do see a PE ratio. They got one, 10.9 versus nothing for the broadcasting industry. Price to sales, 1.2 versus 1. Price to book value, 2.8 versus 1.2. And price to cash flow looks good, 4.7 versus 5.3. And the PEG ratio, only 0.2. Industry doesn't even have one. The lower the PEG ratio, the better. Wow. The earnings are up 50.2% over last year. That's double the industry at 25.8. Sales for Nexstar, they were up 6.6 when the industry was down 5.3. The 5-year growth rate on the earnings chase from the analysts, 69.5% versus a decline of 16% for the industry. So Nexstar seems to be doing all the right things. Ooh, we might be buying this company. They pay a dividend of 3.6%, only use 37% of their money to pay that dividend out. On the balance sheet, I'm hoping something good here. Current ratio, 1.7 versus 2. Debt to equity, not good. This is what worries me about buying more companies. 2.8 versus 1. Net profit margin, 11.9 versus 3.7. Did want to look at their return on equity, 27.8. So they probably have a low equity based on that. And that could be why the debt to equity is so high. So maybe not a problem there. If you're going to look at the company, you really got to look deeply at that. Free cash flow, not a lot. It's $1.2 billion. The industry's at $400 million. So I kind of like everything I'm seeing here. But what do you got going forward?
Yeah, I mean, I'm going to say it's interesting. I mean, you look at Nexstar, again, the ticker symbol NXST, the current price here, $206.36. I'm blown away by this. The 52-week low, $141.66. The high, $212.44. 1-year return is up about 28%, but I'm even more blown away. The 5-year return, gosh, if I can click on it, is 125.7%, and then the 10-year return on Nexstar, 341%. Did somebody forget to tell them that nobody's watching TV nowadays? I mean, that's what it is. It's a broadcasting company.
And as we talked about, that doesn't include dividends. With dividends, it's 399% 10-year return. And compare that to the S&P at 267. So they've done a great job here. I mean, well, obviously, we're on air, so I guess that we're helping there.
I guess. I mean, shoot, maybe they should give us a dividend. But, I mean, that's what they do is they own TV stations. I mean, and it looks like they're agnostic to whatever it is. I mean, it says that stations are affiliates of ABC, NBC, Fox, CBS, the CW, My Network TV, and other broadcast television networks. So it doesn't look like they're like, oh, we're primarily just associated with Fox stations.
Right.
They just own the different stations and the different markets. And what kind of surprised me, did you already bring up the Tegna news?
I did not.
Yeah, I mean, that's what kind of put them in the news here was Tegna, which is one of the other large players in the TV station business. Now, I guess they're in advanced talks for Nexstar to buy Tegna. So, I mean, Nexstar could get even larger in this space. And, I mean, maybe the cash flow on this is just amazing. I was actually talking to somebody at Nexstar, and they were saying, I don't know the exact ins and outs of it, but they primarily try and buy more now in, like, your swing states.
Right.
Which makes a ton of sense because that's where you'd probably get more money from the political advertising.
Right.
It's pretty much a nice cash flow machine, I would assume. With all that said, I haven't given the target selling price yet, so let me do that, and we can maybe continue the conversation real quick. But going forward for Nexstar, we go out to December 2026. I mean, this is interesting. I see estimated earnings per share $25.74 gives us a target sell of $427.28. Forward PE around 8.2 times. I mean, there's a lot to like. Just that balance sheet is a no-go for us.
And I don't know if you saw the 2025 earnings. My numbers are a little bit different than yours, but 2025, $14.07. Mine shows an increase to $26.54. Yeah. So why are the earnings nearly doubling? I'd want to know that before.
Maybe integration costs. Maybe they have had all these buys, and now they've integrated stations, and now those integration costs are subsiding. I'm just kind of speculating here because, I mean, sales aren't going up 95%. Pretty sure by that. So it has something to do with expenses and maybe non-cash expenses to that degree as well.
I think this might be worth a little bit more research because,
Did you see the debt to equity was though 400?
yeah, but we think it's got such a low equity. It's kind of like a franchise company, maybe. Franchise companies have such low equity. This may be a similar business model. I'm questioning.
Maybe.
Yeah. Because remember, I looked at the return on equity; it was really very good. So that kind of told me probably a low equity.
Yeah,
So
that makes sense.
yeah. So, but I'm going to put a potential buy in this one.
Yeah. If you can understand the debt.
Well, yeah, you got to kind of, and again, we try to point people in the right direction, and that's what we're trying to do now. It's like this one, I think, is worth doing some research. It is a growing company. I would want to look at the debt, and also too, you talk about the buy with Tegna. Is that going to be a debt deal, equity deal? That could change things a lot. I think Tegna is not that small of a company.
No, I think it's a decent sized business. It's in the billions, I believe.
Right. We got to move on here. Gosh, time's going by quick here.